let us continue. If you look at this equation again, you will see that while working out the price within the square brackets, the entire coupon, the entire next coupon is being discounted. However, the discount factor is for that part of the period at that point at which the trade has actually taken place, at which the valuation is to be done. In other words, what I am trying to say is that although the interest that is discounted, that is embedded in this formula, relates to the full period for which the coupon applies, the discounting is done for the period up to which the transaction is taking place. Therefore, the price that we get includes the accrued interest, and therefore, it is the full price or the cash price and not the clean price of the bond that we arrive at by the formula, by the cash flow discounting formula. So, that is very important. With the price that we arrive at by virtue of the cash flow discounting formula that the traders do, it gives us the full price or the cash price. It does not give us the clean price, it does not give us the quoted price. Now, in the case of US T bond futures, what are the possible deliverable assets? Now, the important thing while discussing bond futures is that there would be a number of deliverable bonds which would satisfy the short party's requirement or mandate under the futures contract. In fact, any government bond that is more than 15 years to maturity and on the first day of the delivery month and is not callable within callable means it cannot be called back, callable within 15 years from that date can be delivered by the party who is short under the contract to the party who is long under the contract. The choice of the bond rests with the short party, not the long party. The short party, if there are a number of possible options that he has for choosing the bond to be delivered under a short futures contract, T bond futures contract, the choice can be exercised by the party who is short under the futures contract, the party who has to make the delivery. Now, we come to a very important aspect. As I mentioned, there can be a number of bonds that are available, that are trading in the market, which can be delivered against a T bond futures contract. They will naturally differ in terms of maturities, they will naturally differ in terms of coupon rates, and therefore, they will also differ in terms of ITMs. Now, there has to be some mechanism by which bonds across the entire spectrum of deliverable bonds are normalized among each other, and that mechanism is provided through the concept of conversion factor. The conversion factor provides the equivalence between a particular bond which is deliverable against a short position in a futures contract vis-a-vis a certain standard bond. And that standard bond is calculated on the basis of a certain algorithm, but the basic thing is that in US in the CME T bond contracts that mandates a yield of 6% per annum. The 6% yield is standardized in this particular US T bonds contract traded on the CME. Of course, every different countries may have different values of this yield depending on their economic issues, but this particular US T bond has a requirement of 6% yield. So, this conversion factor, the important thing for us is that the conversion factor provides a mechanism of equating across various bonds which are available for delivery against a futures contract. How this is worked out we will talk about in the sequel, but for the moment that is the role of the conversion factor. So, in effect the price that the short position receives, you see he will deliver a bond and the price that he will receive will be given by the most recent settlement price, the cash price received or transaction price received, most recent settlement price into conversion factor plus accrued interest. So, most recent settlement price is quoted in terms of the standard bond. This is important. The settlement prices are quoted in terms of the standard bonds. Depending on which bond he tenders for delivery against a particular futures contract, these bonds have a specified conversion factor which is worked out as per a particular algorithm. Now, you multiply that by the conversion factor, you arrive at the settlement price of the particular bond that is to be delivered by that short party against the futures contract. Add to it the accrued interest for the period from the last coupon date to the date of transaction, and you get the total cash payment that has to be made by the long party to the short party. Now, let us talk about the case of hedging. This is again very interesting. Number of contracts, it really boils down to the calculation of duration as such. We start with the usual expression, the change in value of the hedged portfolio comprising of the cash position and the futures position is given by QS. QS is the magnitude of the cash position into change in price of the cash position, and number of futures into change in price of per futures contract. So, now we use to work out delta S, we use the expression of duration. If you recall, the expression of duration using continuous compounding was ds upon s is equal to minus ds d rs. Rs is the interest, no, here Rs is the interest rate, it is not the yield rate, it is the interest rate. ds upon s is equal to minus ds, therefore, ds is equal to ds into s into this expression, that is precisely this ps is this s, the same thing, this s and this ps. So, qs into ps into this ds into drs. Similarly, we work out for the futures contract. qs, ps is the price, the current price, the spot price, the t equal to 0 price of the cash position, ds is the duration of the cash position, and drs is the change in the interest rates to be hedged again. This is stochastic, this is stochastic, the rest of them are mere numbers. So, when you simplify this expression, you get this expression. Now, if we assume parallel shifts in interest rate, that is the yields change by the same amount, the interest rate change by the same amount for all maturities, then we can write drh equal to drs equal to drf is equal to drsa. And then this all dr expressions cancel out, and we can express the duration of the hedged portfolio. Now, we can express the duration corresponding to this as dh. This is the duration of the hedged portfolio is given by ds, which is for the cash position, this expression, and minus this divided by this expression into df. This little bit of algebra is there, nothing more, nothing technical about it, simply algebra. We are using the same expression, same formula in respect of delta y. Instead of ds, we are using dh, instead of drs, we are using drh, and then we are saying that all these three being parallel, they are equal, and then we are equating dh equal to ds into this expression. Please note, v is nothing but this v is 0, because there is no investment in the futures contract, as I have reiterated again and again. We ignore margin requirements. So, there is no initial investment in the futures contract. So, for perfect hedging, dh must be 0, that means the sensitivity to interest rates must vanish completely, that is for perfect hedging, and that gives an expression for the number of contracts as this. Now, we come to a very important point. If we compare this number of contracts which we have arrived at through this with the number of contracts that we had in the case of short term futures, T-bill futures, we got it as this expression. NF is equal, this is the expression that we have for the current case, that is the T bond futures. if I use if I don't assume that this is parallel, I introduce the factor beta if beta is not equal to 1. Of course, they are parallel, then beta is equal to 1. If the shifts are not parallel, then beta will have some value. But the basic thing is this quantity, you compare this quantity which was there on the last slide also, the same quantity is here. You compare this with this slide, with this expression. The important difference is that here we are having V as 0 and P star f, here we are having F s upon F star s. In other words, here we are applying, we are working out the number of contracts based on the current value of the cash exposure and current value of the futures contract. Here we are working out the number of contracts based on the face value of the exposure and the face value of the futures contract. Where from this factor has arrived? This factor has arrived because of these quantities vis-a-vis these quantities. In this case, when we are using duration and we are using this formula, we are using interest rates. Now, as I mentioned in the last lecture, interest rates apply on the present value and give you the future value. Whereas, when you use yields, which is the case here, in this case you are using yields, in this case you are using interest rates. So, when you are using interest rates, the rates apply on present value, which is this is the present values, these are present values, these are present values. Interest rates apply on this and give you the future values. Here we are using yields. Yields apply on the future values and give you the present value. Therefore, that is the difference which manifests itself in the calculating of the number of contracts. Here the number of contracts uses future values. Why? Because of these quantities vis-a-vis these quantities. These are discount yields and therefore, they apply on face values. Here we are interest rates and they apply on present values. So, that is the reason why you in this differential between the two the T-bill futures and the euro dollar futures vis-a-vis the T-bond futures arises. So, let us look at the assumptions. The above computations use interest rates and not yields, that I mentioned. Duration is based on continuous compounding, that also I have mentioned. If there is no continuous compounding, there will be an adjustment, I will come to it in a minute. Duration is a first order approximation and we have already discussed that in a lot of detail. Convexity is ignored and the analysis ignores changes due to passage of time, which is which is due to the anticipated changes or the anticipated change due to passage of time. We are ignoring that quantity. Now, what I just mentioned was that we are using duration using continuous compounding. If we do not use duration using continuous compounding, if we use annual compounding, then this additional factor will come into play. 1 upon y f divided by 1 upon y s. This again goes back to the definition or the computation of duration, how we define duration. The principle is obviously the same. I have talked about conversion factors. Let us look at this case. We have two bonds A and B. A bond has a principal of 100 face value and a coupon of 10. This is the last coupon, there is only one coupon here, which is to occur at, let us say, t equal to t, whatever it is. The principal as on this date, you will receive a principal of 100 and a coupon of 10. So, the total cash flow is going to be 110. The bond B is slightly different in terms of coupon rate. It gives you a principal of 90 rupees and it gives you a coupon of 20 rupees. Please note, this is the last coupon, there is no coupon thereafter. So, no other effects are there, and the total cash flow obviously in this case is also 110. Bond A is priced at 98, bond B is priced at 96. The question is, would this situation allow an arbitrage or will it not allow an arbitrage? The answer is obviously yes. Why? Because you can obviously take you can buy this particular bond at 96 and take a short position in this at 98. In other words, you get 98 rupees and you pay 96 and get pay 96 and buy this bond. So, buy and sell. Now, at time t, you get the same amount of money, you get this amount of money and you give it against the short position. So, this is all square, and at this point you have made a profit of 2 rupees. You have bought 110 rupees for 96 rupees, you have sold 110 rupees for 98 rupees. Assuming that the risk and all those issues are not disturbed, you obviously end up with an arbitrage profit of 2 rupees. So, the message that I am trying to convey is slightly more deep. The message that I am trying to convey is that the arbitrage process does not depend on the bifurcation of cash flows between principal and interest or coupons. It simply depends on what total cash flows are there. It does not depend on the source of those cash flows, whether those cash flows arise due to a coupon payment, whether those cash flows arise due to a part payment of principal or some other mechanisms is not the relevant factor. What is relevant is the total cash flows. Arbitrage will relate itself only to total cash flows, because that is what you see. Arbitrage relates, at the end of the day, arbitrage converts everything to money, and money does not depend on what source you are generating it from. So, if the coupon is higher or the coupon is lower, so long as the total is the same, arbitrage will take place if there is a price differential and there is no change in risk. If the risk is unchanged and the prices are different, the total cash flows are the same on maturity, then arbitrage will take place. In other words, I reiterate, arbitrage will take place in relation to total cash flows. Arbitrage will not relate. For example, if arbitrage will not take place because of this, no. Arbitrage will not take place because of this, no. Arbitrage will take place because of this. So, now let us talk about the pricing of futures. Now, the future price we have talked about in the context of forwards is given by F0 is equal to S0. Now, why we are talking about this expression? Before I answer that, F0 is the forward price, S0 is the current spot price. What is I? I is the present value of any income that arises during the life of the futures contract. The present value, suppose there is an income here, suppose there is an income here, there is an income here. The present value of all these incomes, the aggregate present value of all these incomes at this point is given by I, and then you calculate the future value of this at the risk free rate, you get the future price or the forward price. Why risk free rate? We have already discussed. But the important question is which price? That what does this signify? And what does this is of course the spot price, so there is no problem. In fact, there is a problem with this as well. What does this signify? Is it the clean price or is it the cash price? And similarly, is this the clean price or this the cash price? That is the big question. The answer is the answer depends on how did we arrive at this relationship. We arrived at this relationship by the principle of no arbitrage. If you recall the discussions we had in the context of forward contracts, we used the principle of no arbitrage to arrive at this relationship between forward prices and spot prices, and that was using no arbitrage considerations. So, when arbitrage is the issue or no arbitrage is the issue, these prices must reflect amounts of cash. They have nothing to do with the quotes of the underlying instruments of the underlying of the forward or the spot. So, what I am again emphasizing is that the spot price and the forward price are both cash prices. They are not the quoted prices, they are the cash prices. So, this formula, this equilibrium formula, this formula that stands in equilibrium is created out of no arbitrage, and because it is created out of no arbitrage, it relates only cash prices. So, that being the case, let us first do a problem to clarify what I have tried to say. Look at an example. In a T-bond futures contract, the cheapest to deliver bond, we will talk about it, but for the moment let us say there is a bond 12% coupon bond with a conversion factor of 1.60. There is a 12% is the coupon rate, the conversion factor is 1.60. The delivery will take place in 270 days. These dates are very important, you must keep track of them. Today is t equal to 0, so the delivery will take place at t equal to 270. Coupons are paid semi-annually on the bond, that is fine. The last coupon date was 60 days ago, that is t equal to minus 60 days back, and the next coupon is 122 days from now. That is, there is a difference between 182 days between this, which is logical since it is a 6-month coupon. And the coupon date thereafter is 305 days. That means, we have one coupon at minus 60, one coupon at 122, and then one coupon at 305, and the delivery is in between them at 270. The rate of interest, the continuous compounded, is 10%. The underlying bonds price as of today, now this is quoted price, this is very important, this is the quoted price, this is the quoted price, calculate the quoted futures price. So, we are given the quoted price of the bond, we have to calculate the quoted futures price, there is a long route to that. We are given this quoted price. So, the first step is, now obviously what we will do, we will use this expression, but this expression is in terms of cash prices. So, the first step is to work out the cash price S naught. We are given the quoted price, we work out the cash price S naught. Second step, work out the present, because there is a coupon payment during the life of the future, we need to work out its present value, and therefore, we can work out S naught minus I. Then we need to work out its future value. That will give us the cash price of the futures. In other words, that will give us the cash price at which the bond will be delivered at the futures at t equal to 270. But we want to work out the quoted price of that futures contract as of today. So, from this, now we have to work backwards. We have to take out the accrued interest component. That will give us the clean price for that bond, the quoted price for that bond. But please remember, bonds futures are quoted in terms of the standard bond. So, we have to divide by the conversion factor and thereby arrive at the quoted price per standard bond. So, these are 5 steps that will have to take place to resolve this problem. Let us do it. So, this is my timeline. Today is t equal to 0. I have a coupon at minus 60, I have a coupon at plus 122, and I have a coupon at 305. What is the amount of coupon? The bond is 12% per annum bond. So, the coupon is 6 rupees. So, this part is explained. Now, the quoted price of the bond at t equal to 0 is 115. Now, as on this 115, please note the last coupon was paid at t equal to 60, next coupon is at 122. So, this quoted price, to work out the cash, let us put it this way, to work out the cash price at this point, I need to add the accrued interest for this period, the 60 days interest which has not been paid, which will be paid at this point, and that will be paid to the buyer. So, this period's interest, the buyer has to compensate the seller at this point. So, in other words, to work out the cash price, I have to add to this quoted price the interest relating to this period, and that works out, because the interest for this entire period is 6 rupees or 6 units. Therefore, the cash price for 60 days works out to roughly 1/3 of this. So, that comes to this much. So, the cash price of the bond at t equal to 0, this is at t equal to 0 today is this much. This is my S naught. So, step 1 is done. The second step is what is the cash flow during the life of the future. During the life of the future, what is the life of the future? 0 to 270. 0 to 270, the future is going to be the underlying is going to be delivered under the future at t equal to 270. So, the life of the future is this, and during this life of the future there is going to be one cash flow on account of coupon of 6 rupees at t equal to 122. So, we want to work out the present value of this, and that present value works out to 5.80. So, this is my I. So, I have got S 0, I have got I. So, S 0 minus I is this amount, and the next step is working out the future value of this at what point? At the point of delivery, at the point at which the future matures for delivery, that is at 270. So, this is the cash price of the future at t equal to 270, that is 119.711. This is the price. This is the amount of cash that the short party will get when he delivers this bond under the T bond futures contract. This is the amount of cash that the short party will receive when he delivers this bond under this bond, this particular bond, right. But we need to work out now we want to work out backwards. First step, work out, deduct from it the accrued interest component, so that I can arrive at what is the clean price of this bond. What is the accrued interest? No, that is the question. You see, the bond is going to be delivered here. When the bond is going to be delivered here, the last coupon payment would have been made at this point 122, and the next coupon is going to be made at 305. In other words, at this point the interest that is encapsulated in this price 119.711 is the interest for the period 270 minus 122. At 122 the interest was given, so the story was over, but thereafter interest started accumulating and that added to the value of the bond in this amount. This is the cash price. So, this includes this amount of accrued interest. We have to deduct this accrued interest, and that accrued interest works out to 4.8525. This is the accrued interest for the period 148 days from t equal to 122 to t equal to 272 at the rate of 6 for 183 days. So, this is the amount of accrued interest in this amount. So, what is the clean price of the bond? The clean price of the future, the clean price is 114.86. So, this is the amount of cash that would be given. This is the amount of cash that would be given when the bond is delivered by the long party to the short party. Out of this is the value of the bond, and this is the accrued interest. So, this is the clean price of the bond. But futures are quoted in terms of standardized bonds, and the bond that we are talking about, the bond that was quoted at 115 had a conversion factor of 1.60. In other words, it is 1.6 times as valuable as the standard bond. Therefore, the quotation in terms of the standard bond would be, this is for our given bond, conversion factor is 1.60. So, for for the standard bond, the quotation would be this divided by 1.6, that comes to 71.787. So, this is how this problem needs to be addressed. So, we have now discussed the basic theme behind the T bond futures. One thing that remains is the conversion factor. Now, when we talk about conversion factor, I will briefly touch on this. When we talk about the conversion factor, there are 4 steps in working out the conversion factor. The first step is whatever is the remaining maturity of the instrument, it has to be rounded down. No, it is not rounding off. Rounded down means it has the next lower value, rounded down to the next lower quarter. In other words, if it is 18 years and 4 months, it is the maturity is rounded down to 18 years 3 months. If it is 18 years and 8 months, it is rounded down to 18 years 6 months. The rounding operation operates always on the lower side, invariably on the lower side, and it rounds down to the next lower quarter. Then we have two situations. Once we do the rounding down, we have two situations. Either the period that we arrive at for the maturity after rounding down is an integral multiple of a 6-month figure, 6-month period, or it is not an integral multiple of a 6-month period. If it is an integral multiple of a 6-month period, then the calculations are quite straightforward. I will show it in an example. You simply work out the present value of the instrument using a yield of 6% per annum compounded semi-annually. So, that comes to be 3% for every semi-annual period, and the discounting is done straight away. The next coupon is assumed to be 6 months from now, 6 months. So, this is as far as the situation is concerned when we have an integral multiple of the 6-month period. The issue of when we have a when we do not have an integral of 6-month period is slightly more tricky. We use the formula that I had mentioned earlier, the transaction formula, the formula for the transaction rate. This formula we use. First of all, we work out the bond price. The bond price, this R is taken as 3% semi-annually, C is the semi-annual coupon, and we work out the price at t equal to 3 months. Having done that, we then bring it back by using this expression, again by using the same 3% formula. By this expression would then become 1.03 to the power 1 by 2, because we are bringing it back by 1 quarter. That gives us the price, the cash price at t equal to 0. I repeat, we work out the present value of all the future coupons at t equal to 3 months, which is the closest quarter maturity that we have. Then we bring it back to t equal to 0 by discounting it by this factor 3% per quarter. Then this is the cash price. We have to work out the quoted price. So, from this expression that we will get, we shall reduce the accrued interest for 3 months. We work it out per 1 rupee value, face value of the bond, and that gives us the conversion factor. So, there are examples of both the situations in this presentation. We shall continue there from here on. Thank you.